And we are back talking about digital lending and who's actually getting a bigger part of that pie. Great, take us through the competitive landscape. Who's doing it better? Who's doing it worst? Who needs to actually improve on what they're doing?
I think Tier 1 banks are doing very well.
Okay.
So KCB, Equity, a cooperative bank. Reason being they were able to transition their clients from branches to agency networks first, and then they were able to transition these to mobile banking. If I look at the likes of Barclays Bank, who are now starting to go through those channels, what they're riding on is a historical premise. So
Okay.
people are already used to mobile banking, so they're just loading onto the platform much more easily. So I think if we look at their traction, they've been able to get 3 million customers in a period of, 3 months?
Wow.
Compared to what we are seeing with the likes of KCB and Equity, which had a significantly longer period of time. In terms of income generation, Equity Bank is still way ahead of the rest of the market. Reason being, they were able to get into agency banking much earlier and mobile banking much earlier than everyone else, and therefore they've been able to monetize their platforms much faster than the rest. So we're seeing Cooperative Bank is now trying to catch up in terms of being able to make money from their mobile banking elements. KCB, I'd say, is actually in the middle. They're doing well in terms of income generation, but they're still yet to catch up with the likes of Equity Bank.
When you compare Equity Bank and KCB, which is a better model? The bank-led, because Equity has taken a bank-led model to digital lending or mobile, using the mobile as a platform for banking, whereas KCB has taken the telecom-led. How does that compare, and where's the opportunity?
In my view, you still have to partner with a telco. I mean, we did see Equity Bank renewed the relationship with Safaricom once again, because there's the understanding that beyond, if you use a bank-led model, the only customers you have access to are customers of the bank. So it leaves anybody who's not in your system out of your reach in terms of a new customer base. If I look at the likes of CBA and KCB, they're able to reach any customer who's a Safaricom customer. And I think that's a much bigger opportunity. So I do think there is value in having a bank-led platform, but then you have to partner with a telco at some point.
Interesting.
But Faith, I mean, I agree with Faith that it should be telco-led because, well, Equity, they had a telco. They actually leased excess capacity from Airtel, which is what they have a Fin service running on. I don't know how
they have the numbers, actually, you're right.
Yeah, but I don't know how that telco business is coming up, because I don't believe that it should be in the bank's core business to issue SIM cards, whether it's a thin SIM or it's a standard SIM card. Because I don't know how that has worked for them. I think they have some friction on that side, which makes me conclude that as a bank, if you want to do, I think collaboration with the telco still makes a lot of sense, because then it gives you the space to focus on your core business.
That's true.
Yes, and then you can roll up. But there's a question of, in a telco-led model, Faith, who owns the client? Is it the telco or is the bank?
So what we've seen moving, I think that was a debate when this was starting.
Yeah.
But what we're seeing in recent times is the telco still owns the client.
They own the client.
Yes, but it is the bank that owns the business. So what we have in terms of even revenue sharing these days, we're actually seeing that understanding coming out, in that, especially for digital lending, it's clear that the banks actually own the risk and therefore tend to have a bigger share of income from any transaction that's happening on this platform.
Do you have a sense of what the split is? Because I remember initially, like, we used to hear when KCB had started partnering with Safaricom, Safaricom would get the bulk of the transaction. Like, they'd get, I think, 70, the split was 70-30, but it was also pegged on origination. Is that now coming closer to 50-50, or does it depend where the client sits or who originates the business?
It depends on the transactions that we're talking about. But for things like transfers, M-Pesa still has the larger share of that, given that money is moving from M-Pesa to the bank. If it's the other way around, banks are still making a lot more money on that. When it comes to digital lending, banks are making a lot more money on that, given that they're the ones taking on the risk. So we are seeing those channels now being priced depending on who is taking the risk and where the customer is originating the business from.
Okay. That's right. But let's get back to digital lending. It's such a very nice, dicey topic. We have about 52 digital lenders in Kenya, and recently they came up and formed an association of digital lenders, ostensibly to fight the push for regulation. because we've seen it coming, the push coming a lot from this from Parliament, and also the central bank the other day coming up with the governor coming and say, these guys, they need to be within our purview in terms of regulation. How should the regulation for these guys look like? Should they be compelled to hold minimum capital? Should they be subject to Banking Act, such that to the extent that now the price should be capped? Should they be subject to liquidity ratio? How should regulation look like? I mean, if you've done some work on this, on digital lending, ideally, how should the regulation look like?
I think first and foremost, regulators need to understand the success of these channels has been mainly because of the deregulation that they have. And so any regulation on these platforms has to be regulation that is supportive of the customer. I think that's first and foremost. And should be able to promote safety in terms of the overall banking sector. So I don't think they need to have things like minimum capital, but there definitely needs to be transparency. I think that is not something that they should be escaping from. I think there needs to be a lot more disclosure to the customer and also to the general sector.
No hidden fees.
No hidden fees.
No origination fees.
I think that needs to be clear.
20% per month.
I think also the agreement with the customer needs to be clearer. They need better disclosures for sure. I think we need to have a lot more clarity on what's going on. I think we do understand. I mean, there's statistics that there's about, for every borrower, they have about 3 or 4 lending apps on their mobile banking platform. So we also need to have a bit more clarity.
That's a lot.
So we need to have a bit more clarity on who's borrowing, where they're borrowing from, how much are they borrowing, how much risk are we sitting on? Because as we speak, we have non-performing loans at about maybe 3%, but we don't. Is
this for the lending sector or for the banking sector? Is it for mobile lending?
So that's for mobile lending.
For mobile lending. And how does that compare to the traditional lending?
Traditional lending, we are at about 12.5%.
So if that's the comparative, it feels like it's not a very risky business, maybe because of the automation. But if this business grows, because today you're saying it's less than 5%, and it's sitting on 3% in NPLs, for me that tells me there's an opportunity there. If that's the opportunity, then what's holding the banks back? Is it that they don't have sufficient capital to be able to run a digital lending platform? Is it that Safaricom will not let them into their ecosystem? What's happening there? Because it sounds lucrative. And even when you talk about the fees for lending, we hear 7% per month. It could go higher. So the margins, it sounds like a high margin, I mean a good margin, low risk business that could grow. What's holding the banks from actually aggressively getting into it?
And before you answer that, that's a very interesting question, because a couple of weeks ago I was in Nigeria, and one of the banks in Nigeria, it's called FCMB, actually has a digital lending platform. They don't call it digital lending, they call it payday lending. They have a payday lending shop, which is turning in more money than even the main bank. Just to piggyback on her question, Faith, do you think that some of these mass market focused banks like Barclays, KCB, Family Bank, Cooperative Bank, Equity Bank, they can actually have a digital space, a shop?
I think there is space for that, but just to answer Bithe's question, in terms of growth, what we are seeing stopping the likes of Barclays, Equities and KCB is also because of the regulation. Remember, they are still a bank, so when they originate a loan, they still have to make some provisions for it. They still have to be able to provide capital against it. So these are regulations that the other lenders that are not regulated actually don't have. And then secondly, in terms of the 3% NPL ratio, I do believe part of that is also understated. Because, I mean, if I just look at the statistics from person to person, you'd find they're closer to almost half, but the declaration of the NPLs is not on an annual basis. So I do think the NPLs are much higher than that than we are having. So I think there's information asymmetry that we still need to bring together.
So that's, she's actually just saying, you're just saying that there's massive risk understatement coming from these guys. But let's get back to regulation, Faith. Couple of months ago, Treasury issued a draft bill which I called Financial Markets Conduct Authority. And you've talked about, when we were discussing potential to regulate this digital space, and you actually saying that actually their conduct needs to be checked generally. Disclosure, pricing, debt recovery. Some of them are very aggressive on debt recovery. We have situations like even no cash, sending an SMS to your sister and your mom, you know, could you please remind X and X to pay her debt? She's overdue. So essentially it speaks to a lack of proper market conduct.
Yes.
When it's conduct, do you think they're better off self-regulating, or they'll still need to have a body regulating them? In your assessment, from some of them.
Who should regulate?
Yeah, it's definitely not the central bank.
I actually think the central bank should do
I think the central bank is overwhelmed.
I think, because we're talking about from a conduct basis, I think central bank still has, first of all, it has a history on banking in Kenya, how we've done it. So they do have the expertise to actually regulate. And I think they can be able to ride in between the conduct bit of it and also the capital bit of it. I think conduct is the major issue at the moment. So I think CBK is well able to do that at the moment. And I think in terms of them having an association, I think what that helps is also to lobby for themselves. Because what we're saying is we have a market of about 52 lenders, and you want each of them to actually lend in an honorable way, such that it does not destroy your business as the other party lending. And I think it's also a realization on their end that regulation is going to come at some point, and they would want to have a seat at the table when they're actually negotiating for regulations for themselves as well.
I take a slightly different view, and the fact that central bank they don't do a good job on the wholesale retail market conduct. So what central bank does is it checks on the conduct on the wholesale market, basically between banks and banks, and also the conduct in terms of regulation, prudential regulation. Are you meeting certain preset thresholds as far as prudential regulation is concerned, whether it's liquidity ratio, it's capitalization? Well, when it comes to the interaction between an entity and their customers, well, could you go complain to central bank today if you've been overcharged on your credit card fees, late payment fees, or whether you've been double charged on late payment fees on your credit card? Well, the central bank doesn't have a desk for that in the first place. So when you are aggrieved, and you've seen it in Kenya, most people tend to go to court.
Yes.
Because the central bank doesn't have a desk for customer complaints. So on that basis, then we need to have a market conduct authority, which sits outside the central bank and handles the conduct of lenders, whether it's digital or mainstream, their conduct between them and the customer. So if today I have a complaint, I've been double charged on my late.
So then you're saying
then you can actually walk in there and say
that the regulation needs to encapsulate that element of consumer protection.
The consumer and today you have I mean, if you've seen in the newspapers, people go to courts and say, I have been,
I think that's you have to capture consumer protection in that regulation. But then she's also saying that in a way you could be over-regulated in the industry. And she's saying that thing that is limiting the growth of this more efficient channel that needs to actually happen is regulation. So if you say that maybe there's the element of regulation focusing on consumer protection, certainly I'm in agreement to that. But then I want to go further and ask, then the regulators that we have today, are they using the right approach to evaluate the bank that's going to look very different tomorrow? Because we've seen so many people who are coming into the payment space, right? So we have what Facebook is doing, what WhatsApp is thinking about doing, Libra, and people just need access to money. Lending is all about, I want access to money, can I be able to get it? And the question to you today is, we have the likes of Branch and Tala that are also doing digital lending. The banking sector in Kenya as it looks today, your tier 1, KCB and Equity, are they transforming fast enough to continue being the big lenders tomorrow? Or could we wake up in 5 years and have somebody else being a tier 1 lender in this country?
I think it will take a while before we get there, because if you look at, on average, the size of credit in Kenya, we are still at about 80,000. So it still means the bulk of what the lending that we are seeing a lot more micro lending, but those are very small amounts. So there's still massive room for growth in terms of being able to scale up. If I look at Equity Bank that has been doing lending for a while, they're yet to get to an average lending size of say 15,000.
So it takes a bit of time.
It takes a bit of time.
But if I may ask you, so today we wanted to just see this digital lending opportunity. It's an emergent opportunity. When we're looking at the banks that are listed on the NSE, I think you've talked a lot about KCB and Equity Bank. Do you think that this opportunity has been fully priced in? And even on the onset of seeing CBA and the NIC merger, is that then another bank that we need to be looking out for outside of the regular banks, and who actually has the best opportunity to tap into that opportunity from the way they're set up with regards to the infrastructure and the personnel?
I think definitely NIC CBA merger is one to look out for. Remember, CBA became a tier 1 bank purely because of Mshwari.
All right.
So they have mastered the art.
They
of
have
digital
mastered. So
lending.
then that's something to look out for.
Yes.
Unfortunately, time is never on our side. We need to have an extensive conversation. But before we go, please, we would like to hear your final thoughts as well as your final thoughts on this lending opportunity and the Kenyan banks and what it means.
I think the lending opportunity in Kenya is still very huge. I still think we need to understand our clients much better in terms of banks lending to individuals. I think there's still room to understand how to lend to them. So I still think there's room for credit to grow in Kenya. I think there's room for the banking sector to change the way they lend. So I still think there's a learning process yet to be fully used.
Okay.
Dear banks, please wake up. The rate caps are not going anywhere.
Very good. So we've had a very interesting conversation. We're saying that digital lending or the mobile banking platform is the way to go. Don't leave. We are taking, the show is coming to an end for now. Closing numbers of what happened on the NSE yesterday, details of what the 33% jump in turnover was all about. Join us this afternoon for Markets Today, where we'll keep you updated with the insights on the NSE. Thank you.